What's going on, everybody, and welcome to Galaxy Trading lesson number 1 on the introduction to reading price action. There's going to be about 9 concepts that we're going to talk about over the next couple of weeks. I figured I would just make these videos in order for us to kind of speed up the process, especially on entry, so that when we do our live calls, you'll have a much better idea of everything that's going on. So in this video specifically, we are going to talk about the concept of imbalances, how to find them, what they are, and how we can use them to be successful in our trading ventures. All right, so what is an imbalance? In short, an imbalance is a lopsided price movement. Okay, so what I mean by a lopsided price movement is that inside a specific range, price was leaning, whether it was towards the buyers or sellers, in such a lopsided fashion that it's creating an imbalance in price. When you have an imbalance in price, our expectation is when price retraces lower back down into that imbalance, we're expecting, whether it's a bullish imbalance, for price to get into it and take off to the upside, and vice versa. If it's a gap down, when price moves higher into that imbalance, we would expect a rejection for lower prices, right? So that's basically, in short, it's a specific region or range on the chart that I'm going to show you how to identify, that when price gets into it, we are expecting a move to occur there, right? And if you've watched any of the videos I made on YouTube, I always say every price move is justified, right? And I firmly believe that every move, if we look left and we have information to our left, we can justify every single price move that occurs on the chart, right? But this is just the glaring one, and obviously because I'm making this video like this, I'm cherry picking it. But again, you throw in or ask me about any chart and we can go through it, and you'll see that every move can be justified. But here in this specific situation, right, you'll notice price bounces here, okay? So if we were to look left and we look in this specific region, we'll notice that this is our first type of imbalance that we look for. There's 2 of them, okay? So the first form of imbalance that we're going to look at today is called a fair value gap, right? So what that's insinuating is, and you see where I put this rectangle, I'm going to remove it just for 1 second, but you'll notice that on either side of this candle, there is no wicks on either side of that candle, right? So if there are no wicks within this specific range on the chart right here, right, that price is lopsided or imbalanced, right? So I use this example. Imagine you're sitting on a seesaw and you're on one side of it and nothing's on the other side, right? Naturally, you're going to the ground and the other side's going to be up in the air, right? So in this situation, the buyers who were taking total control of this region, right? No wicks, so it means price was not contested within this range. So again, that's us, and for every time price were to retrace back down into said imbalance, right? That's like you throwing a sandbag on the other side, right? Might not be enough just on one sandbag, right? Let's say it's one tap, right? One tap might not be all that's necessary to balance that price range out and for price to move freely again. So obviously here in this situation, you'll notice price retraces back down into it, perfectly fills it up, and takes off again, okay? So again, this can happen on either side of the chart, but this would be our first form, and this would be a fair value gap. So again, let's just see if I can identify any more fair value gaps that occur in this chart. Do they all need to get filled in? No, not necessarily. You're going to notice that there are probably a lot of unfilled fair value gaps below. So let's just take a look and see. Okay, so I see one right off the bat. Ready? From this high wick here to this wick right here, you'll notice on either side of that candle, there is no wick or no contesting of price in this specific range, okay? Let's continue. You'll notice, okay, we have another one here, very small, but still plays. Ready? From this candle's high to that candle's low right there, look. You see there's no wicks on either side. So to me, that is just an imbalance in price to the upside, right? A buy side imbalance, and there's an inefficiency to the sell side on these specific gaps right here, okay? Let's look here. Nope. So we have our body here and we have a wick here. So this candle is not imbalanced at all. Okay, this candle here, you have your wick here, you have your wick here. No imbalance here. Now let's take a look at this one right here. Ready? So here's your first wick. Okay, wick. Up to that wick, right? No wicks on either side of this 3 candle run, right? you'll notice price gets into it and takes off, right? Okay, so how do you control yourself over the gaps, right? Well, oftentimes that trade, those wicks are going to give you the heart attack, but the bodies of the candle are telling you the story, right? So how do we know when it's a good time for potentially an all-out stop, right? I use the candle that creates the imbalance, the low of that candle. So this candle here created the imbalance, right? So my stop out is going to be the low of that candle, okay? And I'll show you guys how you can use them to actually trade off of, and it really just sets your trade plan, and that's why I love these imbalances so much. But now, so that's just the concept of the fair value gap. We'll go to another chart and we'll look for some bearish fair value gaps as well. But this is just bullish fair value gaps. The same thing would apply. I think, yeah, you have one right here actually. So we might not have to go to another chart. But here's what a bearish fair value gap looks like. Ready? Let me zoom in and just make it a little better. Whoops. Okay. So again, we anticipate when price gets into our bearish fair value gap, price is going to reject lower, okay? Ready? So here's your low here, and there is your, see that? Your high. So I'm going to go over here and change the color to red, and that would be a bearish fair value gap, okay? So you'll notice that on either side of this down close candle, within this rectangle right here, there's no wicks on either side, right? So if there's no wicks on either side, that is an imbalance in price specifically to the downside, okay? So how can we view this, right? Well, look what happens when price gets back up into it, right? Wicks give you the heart attack. Did it take out the candle's high in this situation where it would be our all-out stop? Nope. But the wicks will give you the heart attack. The bodies of the candle are telling you the story. Look how perfect that is. And it creates your next leg down. Okay, so this was our first attempt, and you're going to notice, you'll say, hey, well, what happened here? We made a run through. Remember, it's just balancing price out, right? So again, on the first attempt into those, we have our whatever our expectation would be. So in a bearish fair value gap in this particular situation, we would expect a rejection here, okay? But when price takes off and moves up through the second time, right, what it's really the dead giveaway would be the creation of a bullish imbalance through a previous bearish imbalance, right? So there's your bullish imbalance right here. Boom. And right up and through, that's your second attempt, right? So that's just, again, how you can use it as a way to, pinpoint entries, pinpoint your take profit, pinpoint your stop loss. Everything is well defined when you use the concept of imbalances, okay? So let me just remove this for a second because it's no longer valid. Obviously, we filled it up. Next time through, we made our way up and through. But as you can see, look how beautiful this is, right? You make your imbalance candle up, no wicks on either side. Price retraces back down into the imbalance, specifically 50% of it. And that's something we'll touch on at the end of this, this video. And we take off again, right? Create another imbalance to the upside right here, actually. So I'll just annotate it, right? You see no wicks on either side of the candle. Okay, that's all we have to worry about right now. So we'll continue down lower, okay? And now it's time to show you the second form of imbalance. And in this situation here, this is a bullish or bearish volume imbalance. And you guys probably all know this. It's really not that difficult to understand, but this is using the advanced gap theory, right? So we will use, I'm going to do another video on this as well, but gap theory, just think about it. If price is moving higher on a gap, right? To me, that's showing me urgency to move higher, right? So if we have an urgency to move higher, how should I view that specific gap or that specific level? I'm viewing it as bullish, right? If we're making a gap up, that's showing me urgency to move higher. If we gap lower, that's showing me urgency to move lower, right? So here's an example of a gap higher, right? And I wanted to dispel the theory, and that's why I'm going to make a separate video on gap theory, but gaps do not always have to get filled. It's the biggest misconception. People just like saying it, I think, to sound smart on Twitter, but they do not have to fill, all right? This one back all the way from March of 2023. Did we fill that? Nope. Look at any chart, any time frame, don't matter. You're going to see gaps all over the place, and they're not filled. They don't need to get filled. But by using this advanced gap theory, you'll notice, look at this. Price gets into our gap and we take off and we're gone, right? So with that being said, right, those are our two forms of imbalances. We have fair value gaps and we have volume imbalances, okay? Fair value gaps are with candles, volume imbalances are gaps higher, okay? Now, how can we trade off of this? How is this helpful to us, right? Well, like I said before, it's always defining what your entry, exit, take profit are every time, right? And what do I mean by that, right? So let's look at any one of these imbalances that formed. Okay, so this is a bullish imbalance right here, bullish volume imbalance specifically, okay? Let's say we use the high as our entry, 12,435, and we want our stop to be below right here, this low right here, because again, this is the candle that created that bullish volume imbalance higher. We want to use the low of that as our stop. Where would we look for our take profit, right? Well, we can always look for our take profit at the recent swing high or buy side liquidity. And in this situation, it was here at 13,091. So after price gets up here, right? I personally don't want to long this, okay? I want it to get into a discount bullish imbalance, and I have a video set for us to talk about the range, because while the imbalances are nice, matching them with the concept of a range is going to just elevate the success rate by a lot, okay? And I'll explain that in a second. But you'll notice, look, entry, were we red on this trade for a second? Yeah, we were. But guess what? We knew where our stop loss was going to be, so we're not bag holders, right? We know where we're going to take profits at our swing high, bingo, right? And you'll notice price does end up coming back down here even after breaking above it, so you would have another opportunity in this bullish imbalance as well, right? So everything is so well defined every time that we look to take a trade, right? Does it not come down sometimes? Yeah, sometimes it doesn't. And you know what? It stinks. You miss out on a trade, but guess what? There are so many stocks, ETFs, futures, anything that you want to trade that just because you miss one, it's not the end of the world, right? I miss them all the time. It's not a big deal. Okay, but just quickly, I want to show you what imbalance would we use or would we want to use in order for us to make better decisions, okay? So you'll notice that in this specific price run right here, right, we are taking out this candle's high, okay? So I'm going to mark that candle's high just for show here. Okay, so the fact that we took out that candle's high with obviously a bullish move higher, what is that telling me? That's telling me that we have a bullish range or bullish market structure, okay? So when we form these imbalances, where are they going to act or be the most powerful? It's going to be in discount of a bullish range. So for example, what would be discount of the range? Okay, so let's take a look. Ready? Right here, bang. All right, so the price run that took out this high here was from that low to that high, okay? You'll notice that at 50%, 50% of our range is going to be our fair value or equilibrium of a price range, okay? So why would I not look to short that bearish imbalance right here? Okay. The reason why I'm not looking to short this right here is because we're in a bullish price range, okay? We took out this high here with that price run. So if that's the case and we get that imbalance candle down, all that's showing me is that we're probably going to go down into discount, which we do here right at 50%. And from that point at 50%, we take off for our high again, right? So when we're in a bullish price range, I'm not really looking to short. I'm looking for price to retrace down into discount, and specifically a discount bullish imbalance right here, right at 50%. So 50% and below, that would be our discount range. Now you can get even more picky or particular if you want to, and only look for retracements down into the golden pocket or the 62 to 79% fib range, right? I don't trade off Fibonacci. I use it to map a range, but if it meets the criteria and I have on a retracement and I have a bullish imbalance down here in discount, that's when I look to actually take the trade. Okay, so from this instance here, right? Price gets into this bearish imbalance, and while it does kind of, stall out a little bit, you'll notice after we hit that discount, we make our next price run. So from this point, all I'm doing, and again, I know we're looking at the weekly time frame, but it don't matter. You can look at any time frame you want. And now look, okay, so the start of the price range to our high, right, of the price range, did we get a 50% retracement? Nope. So what is that telling me? Well, what that tells me is this would be a trade that I missed because we did hold this bullish imbalance perfectly, but guess what? I wanted to get into discount, and the fact that we didn't get into discount, oh well, it happens, right? So what is realistically, what is this telling me is the range is not set just yet. So if the range is not set just yet, I need to go find out where we're going to reset our range, and we're going to get our retest of 50% of the range. Aha, here it is. And this is just a situation where we can be right this whole entire time, but we want to be right when it hits 50%, because at that point, our risk reward is pretty dang good, and we kind of have a good idea of where price might want to end up, right? So that would be our range. Why? Because up until this point, you can go to every single high candle here, and we never retrace back to 50%, okay? But once we get to this high here, what was our indication that might be time for us to go a little lower? We form a bearish imbalance right there, the one that we looked at before. There it is. Bang. Price gets up into it, retraces lower. Even in this price run, okay, watch this. If we want to be really specific, okay, did we take out a low in this price run? Yeah, we did, right here, right? We took out that low with that price run, okay? Now watch this. Ready? Here's your high to your low, right? We took out sell side, we took out a low to shift short-term market structure bearish, okay? Why did we bounce here? Well, we had this bullish imbalance right here, so it makes sense, right? Again, every move can be justified with what we're looking at on the chart, okay? Price moves up into our bearish imbalance. Are we in discount of the range or over 50% in a bearish range? Absolutely, and there it is. What would our criteria be for our trade here? Entry off of the imbalance, okay? Stop loss above the high that created the imbalance, and take profit at the lows. There it is. Bingo. Took it, okay? Again, you could do it again here. Ready? Watch this. Okay, high to low. Here's our retracement into discount above 50%. Here's a bearish imbalance right here. Whoops. Boom, boom. There she blows. Retracement in. Dump. Bang. Okay, and at that point, we finally get to 50% of our overarching or our higher time frame bullish range. And then from there, if you go back on Twitter, you'll see that was when I called that low. I like this low a lot. At MANDOTRADING, you can search that and it'll come up. But this is all it was, 50% retracement into a bullish imbalance, and we take off, and our target would be the highs. So in short, that's really the concept of imbalances, and I do think it's very important to have the ability to identify a range, because identifying a range shows you the more favorable bullish imbalances, bearish imbalances. But without that, without the range setting, bullish imbalances, which are in premium or over 50%, would be something like this, right? You can get a bounce here, but it's not one that I'm looking to long. I like when price gets down into discount, and the reason I like it is just based on what my risk reward would be ultimately for the trade to the upside, right? If we're buying it up here, and let's just, I forget what we had the range set specifically here, but if we're to come right here, you'll notice that, it was lower here. Yeah, because we never got to 50% on that retracement. Okay, so ready? If we were to long this, right, I don't have a set number here, but really maybe 25%. So we're really looking only at 25 points to the upside, while the entirety of the range is 75% down. I don't like the risk reward there. It doesn't make sense to me. Okay, so yeah, that's a lesson one just on imbalances, what they look like, with the meaning behind them and how we can use them to map out trades. So I'm going to put this out for everybody. If you have any questions in addition, please feel free. This link is going to be in the syllabus. You can go check it out there. But thanks for watching. This is lesson 1. I'll just tell you the other concepts that I want to look at over the next couple of weeks, and liquidity is one. I think that's the driving force of the market. You have market structure, which I kind of just showed you how we map the range. Breakers, order blocks, new week open gap / new day open gap. Our time signatures, because time is extremely important and something that I think is so underrated. And then we look at how we can formulate some sort of bias going into a week. So this is all I got. Thanks for watching, and we'll talk soon.